The 5-point entry approach reduces both your risk of loss and your risk of opportunity costs simultaneously. It helps you save your ammunition to help you increase the odds of hitting your target. If traders are front running your trade idea, then this approach helps to ensure that you still have some skin in the game. Now, some of you may never have heard of the word front running, so I'll very quickly explain what I mean. If everybody is looking to take a trade at $20, then front running would mean that many people would start to place their orders a little bit higher. For example, $20.10, then $20.20, $20.30, and so they keep raising their orders higher and higher. This is how front running takes place. It means that a large proportion of orders will be placed higher than your intended entry price, and this means that you may not get into your trade. So this approach helps to ensure that that doesn't happen to you. The 5-point entry approach will also help you with the flip side of that example. And the flip side is that if price falls straight through a level, it could be because market makers are hunting for stop losses. So then using this approach will ensure that you reduce your drawdown when entering into the trade and simultaneously maximizing your exposure. So really, at the end of the day, it gives you the absolute best of both worlds. Now that you have all the theory behind you, let's have a look at a visual example to try and put this all together. So if you have a look at the slide over here, the 5-point entry approach, this is an example using a long order. Now assume that our stop loss would be placed just below this number 5 level whilst I explain this approach. So a couple of ways that you need to stagger your orders. Number one, the first order is slightly above the key level. This gives you protection against that front running, ensuring that you still get some skin in the game in the event that market makers or traders are front running that particular level. Number two, you're going to put the order at the exact key level where you would expect price should bounce, or in the case of a short trade, where price should reject from. Number three, you're going to place another order slightly below that key level in the event that market makers are looking to push price through to stop out retail traders. And number 4 and 5, you're going to place your orders ever so slightly, just a tick above where you would have set the stop loss. Now, this ensures that if market makers send price even further down, then you increase your exposure whilst reducing your drawdown because you only have 3 out of the 5 orders entered. So this is just a very quick overview just for you to have a basic understanding. In the next video, I'm going to take you through real life examples of an actual trade that I've taken using this approach. So without further ado, let's get into it.